Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So the One Big Beautiful Bill Act has been signed into law. And the question is, what does that mean for you from a tax planning perspective? Well, let's start with an example, and I want you to see if you can find the mistake in the following tax planning scenario. So let's say that for 2024, you are married filing joint. One spouse is 65 years old, the other one is 64 years old, and this was your tax return right down here for 2024. So right here you have $4,000 of taxable interest, we have $7,000 of ordinary dividends, we have $13,500 coming from an annuity distribution, $45,000 collected in Social Security, leading to AGI of $33,050. That is offset by a standard deduction of $30,750, resulting in taxable income of $2,300 and tax of $231. Note that the standard deduction for 2024 in this example is the $29,200 base for 2024, plus an additional $1,550, which is the additional standard deduction for someone 65 years of age or older. In this case, we have one person who is 65 or older in 2024, so the total standard deduction is $30,750. Now coming over here, let's say that for 2025, you are still married filing joint. One spouse is now 66 years old, the other spouse is 65. And let's just say that this is the tax return that you are currently expecting based on your income projections for 2025 as of today. So for simplicity, let's just say that we are still expecting $4,000 of taxable interest, $7,000 of ordinary dividends, $13,500 from annuity distributions, and $45,000 collected from Social Security. Those are the same numbers that were right over here for 2024. And yes, I understand that generally speaking, some of these numbers, in particular the Social Security benefit, would be expected to grow by inflation. But for this example, let's just keep the numbers simple. I'm going to have these four numbers right here be identical to the previous year. Now skipping right down here to the standard deduction for a moment, we have $34,800. And for 2025, that's going to consist of the original $30,000 base, which was the law for 2025 before OBA. We have $1,650, which is the additional standard deduction for someone 65 years old or older. In this case, both spouses are now 65 or older, so we're going to have two instances of this. We're also going to add on another $1,500, which is the OBA standard deduction bump. This bump is for everybody married filing joint. This does not have to do with age. Basically, it's a bump of this $30,000 up to $31,500 for 2025. So now we have a grand total standard deduction of $34,800 right here. And the last item I want to bring your attention to right here is this $12,000. Now, what is this item? Well, this is the OBA senior bump. Remember that under the One Big Beautiful Bill Act, there is a new senior standard deduction, which I am going to call the senior bump. The amount is going to be $6,000 per person, and there are some income thresholds that will phase this out, but in this case, on this tax return, we do not exceed those income thresholds. So we have two individuals, both age 65 or older, both eligible for the $6,000 senior bump, leading to an additional $12,000 of deduction. Now remember, under OBA, this is supposed to be available for everybody who is a senior, whether you itemize or take the standard deduction. In other words, this is going to be what's called an above-the-line deduction. Above the line means it's above AGI right here. It's not actually included included in the line right here where you put either your standard or itemized deductions. So that is what this $12,000 represents. That is the senior bump of $6,000 under the One Big Beautiful Bill Act, multiplied by two people in this case who were both eligible. So right now we're looking at taxable income of 0 and tax of 0 in this particular case. Okay, so now that you see where all of the numbers on the returns above are coming from, here is my question to you. What is the tax planning mistake that is being demonstrated in 2025 on this tax return right over here? Did you identify it? Well, the tax planning mistake in this example is visible right down here as identified with the green arrows. You have $14,000 of AGI left after the $12,000 deduction for the senior bump right here, and you have $34,800 of standard deduction, which means what exactly? Well, it means that you have tax-free room to absorb income. In other words, it means you have the opportunity for a 100% tax-free Roth IRA conversion in the amount of approximately $12,800. Here is the original 2025 return from above. All the numbers on here are exactly what we looked at before. There is no Roth IRA conversion present right here. This is a revised version of the 2025 return with a Roth IRA conversion in the amount of $12,800. And you can see that in both cases, we are still at taxable income of 0 and tax of 0. On the original return, although the senior bump of $12,000 was present, you were not taking full advantage of this deduction. But over here with the senior deduction present, we are taking full advantage of that additional deduction being provided for 4 years between 2025 and 2028 is when it's good for. And by utilizing that, we were now able to get a free $12,800 Roth conversion. That's $12,800 which escaped taxation when it went into the traditional IRA in the first place. That's $12,800 which escaped taxation when it was converted to a Roth IRA. That's $12,800 which escaped taxation permanently, never to be taxed again, including all future earnings. Imagine missing that because you wouldn't take the time to simply lay out your numbers and do some simple tax planning. Most Americans don't. Most Americans don't do anything when it comes to simple tax planning. Now let's switch gears for a moment, and I want to ask you a question. Now that OBA has become the law, have you asked yourself this? Is the government coming after my money now, or is the government coming after my money later? Because we all know that the government is coming after your retirement money at some point. After all, that's what an RMD is. An RMD is the government coming after your retirement money as fast as possible. And what is the largest pool of untaxed money sitting out there right now? The answer is it's your 401ks and traditional IRAs. And a future Congress is going to be salivating over this enormous pool of untaxed money. It's the money that you are planning to use to live out your silver years just sitting there, untaxed and vulnerable. A future Congress is undoubtedly going to be salivating to get their hands on some portion of this money, just like they were salivating over your money when they created RMDs in the first place. Okay, but now wait a minute. I thought that the Big Beautiful Bill Act makes all of the lower tax rates permanent. Well, you are right. It does make all of the lower tax rates permanent, but the government can easily increase the speed at which it comes after your retirement money without any change to the headline tax rates in the future. Let's do an example. Assume that your expected balance between 401ks and traditional IRAs when you reach RMD age is $1.8 million. So you have $1.8 million in retirement accounts. You also have other annual retirement income of $75,000. So jumping over here to step 1, you grab your IRS publication 590B tables and you calculate your first RMD at age 75. As an aside, remember that the RMD age will change to 75 starting in the year 2033, so let's assume that that is what is applicable in this situation. So we go right down here to table 3, the uniform lifetime table. We go to your current age, which is 75. We go over here to the distribution period, which is 24.6, and then we hop right down here to our first year RMD calculation. There's the untaxed IRA balance of $1.8 million. There's the RMD factor at age 75 of 24.6. And so we have a first year RMD of $73,171. Now step 2, you prepare your taxable income calculation and determine your tax due. So right here in your taxable income calculation, we start with all of your other income, which we said was $75,000 annually. There's your RMD income, which we just calculated at $73,171. That leads to AGI of $148,171. There's our standard deduction, which I'm just going to project as $35,150 for the year 2033. Obviously, the exact amount in 2033 could be different than this, but this is just being used for illustrative purposes. So that leads to taxable income in this example of $113,021. Now we hop over here to our rates and brackets. We're going to assume that the tax rates are the same in 2033 as they are in 2025. Here's the 2025 actual brackets, and I have just projected 2033 brackets based on a 2% inflation rate between 2025 and 2033. And so now let's allocate our taxable income to the brackets. The first $27,944 gets taxed at 10%, resulting in tax of $2,794. The next $85,077, which is the total taxable income right here of $113,021, minus the top of the previous bracket, $27,944, that leads to $85,077 being taxed in the 12% bracket, resulting in tax of $10,209. So on this total taxable income of $113,021 that we are projecting in this example, we have tax of $13,004. But what if at some point in the next 10 years or so, circumstances in the United States change and Congress decides that they need money? Now, they probably don't want to change the headline tax rates, as we've just mentioned, because that would probably be unpopular from a political perspective. However, I should note as a quick aside, remember that making the lower tax rates permanent, that just means that the law won't expire automatically at some specific future date. Permanent does not mean that the law can't be changed. The law can still be changed by a future Congress. Anything in the law can be changed if there is appetite to change it. But let's stick with our assumption that we previously had. They don't want to change the headline tax rates because that would be unpopular, so they need to figure out a way to tax you more without you really realizing it. So they go to their handy-dandy little RMD distribution table in IRS publication 590B that we just looked at, and they change these factors down here a little bit. Just enough so you don't really notice. So now 2033 comes around and you go to calculate your first RMD. The two-step process is the same. Number one, you grab your IRS Pub 590B tables, you calculate your RMD. Number two, you calculate your taxable income, and then you calculate your tax due. So right here is the first year RMD calculation with the revised factor. The untaxed IRA balance remains the same at $1.8 million, but the RMD factor at age 75 has been been quietly changed from 24.6 down to, just 22.3. No big deal. So you drop in your 22.3 and you calculate your first year RMD of $80,717. Now we hop over here to our taxable income calculation. Considering the revised factor, all of our other retirement income remains the same at $75,000. Our new RMD income is now $80,717. That results in AGI of $155,717. We're going to keep our standard deduction the same as the previous example at $35,150, and that results in taxable income of $125,688. So hopping down to our brackets, the first $27,944 of taxable income gets taxed at the 10% rate. That is the same as the previous example. Now we have $85,648, which is the top of this bracket right here minus the top of the previous bracket. That amount is taxed at 12%, resulting in tax of $10,278. And then finally, the remaining amount of $6,975 of your taxable income that gets you up to the grand total of $125,688. That amount has been bumped up into the 22% bracket in this example. If you recall, when the RMD factor was the original amount, we had not actually exceeded the 12% bracket. But with a sleight of hand adjustment to the RMD factors, Congress was able to bump up your first year RMD, actually all future RMDs in this example, thus causing some of your taxable income to be bumped up into the next bracket. That results in an extra $1,535 of tax for a grand total tax in this scenario right here of $14,607. Now let's look at the results between the two scenarios. So the tax with the original RMD factor was $13,004. The tax with the revised RMD factor was $14,607. That results in an annual projected increase in tax due to revised factors in the RMD calculation table of, let's just say, about $1,600. Multiply that by a 30-year retirement and your family has paid in additional tax over that time period of $48,094. That is $48,000 of your family's IRA money lost permanently. Did they change the headline tax rates in this example? Nope, they sure didn't, but they did manage to get more of your family's money. And how did they do it? All from something as seemingly innocuous as adjusting the RMD factors on page 67 of some IRS publication that most people have never heard of. Now, is that exactly the method that a future Congress will use to come after your family's retirement money? Only time will tell. But the example leads me to the two questions I have for you as we kick off this video. Do you believe that the government will be coming after your money in the future? And if yes, what can we do today utilizing the new tax provisions of the One Big Beautiful Bill Act, which just became the law, to protect your family's hard-earned wealth from the unknown steps of a greedy future Congress that is looking for money? By the way, if you enjoy this video, please like and subscribe, and let me know in the comments what you think about the new tax provisions that were just passed into law under the One Big Beautiful Bill Act. So what is your answer to the questions that I just posed on the previous page? Do you believe that the government will eventually be looking for more ways to come after the largest pool of untaxed money that is sitting out there today? Now, why would a future Congress need money? Well, according to this article here from Fox Business, and this is something that I'm sure you are well aware of, the U.S. national debt debt held by the public as a percentage of gross domestic product is currently at 99% and is projected to rise to 117% by 2034. And that is under the current law, though the One Big Beautiful Bill Act is projected to increase that. So if I'm reading that correctly, we are about to enter a period of time in U.S. history where the national debt is going to be more than our gross domestic product. Now, I'm not an economist, so I will leave the broader macroeconomic implications of that situation for you to decide for yourself. But I would argue it's safe to say that at some point in the future, quite possibly when you're just about ready to retire, Congress is going to be looking for all the money it can find. And the largest pool of it, the low-hanging fruit, so to speak, is sitting right here. According to NerdWallet, Americans have $8.9 trillion invested in 401ks and $15.2 trillion in IRAs in the third quarter of 2024. All of that money is untaxed. And all of that money is what Americans are planning to retire on in the coming decades. And all of that money is likely what Congress will be eyeballing in the future in order to fill the coffers as much as possible. If we hop back over here to the results of the previous example for a minute, yeah, it's only $1,600 a year in this hypothetical situation, but over 30 years that can add up to nearly $50,000. Now multiply that by every American who is retiring with an IRA and you can see why Congress will be eyeballing this untaxed pool of money. And also, as we demonstrated in this example, they don't have to raise the headline tax rates. There are countless ways that they can tweak small things and slowly take away more and more of your retirement money without you really even noticing. So I hate to say it this way, but really it's the only way that it can be said. Who is going to pay that bill when it's time to pay the piper? Is it going to be you and your family? Or is it going to be your neighbors? Because somebody is going to have to pay. Eventually the time to pay that bill will come. And in my opinion, the families that are the least tax efficient today, not just today, but over the next 5, 10, 15 years, they will end up paying the most of that outstanding bill. Conversely, the families that are the most tax efficient today will end up paying the least amount of that future bill. Those who are able to recognize that we currently have a combination of circumstances that is providing one of the greatest tax planning opportunities in American history. We have right now under OBA some of the lowest headline tax rates in modern history, and we have that combined with the largest tax bill ever that is looming in our future in the form of national debt. So when I said earlier, have you asked yourself this question, is the government coming after my money now or is the government coming after my money later? I hope your answer was, since under OBA the government is actually coming after less of my money right now, I am going to take full advantage of that so they don't have the ability to come after more of my money in the future. Many people are going to have some great opportunities to permanently save tax under the provisions of OBA, but you have to want to take advantage of them. You have to want to sit down and lay out your numbers and figure out where the tax savings are, because this unpaid tax bill is looming out here in the future. Now, just to be clear for any of my new viewers and as a reminder for my existing viewers, this is not an argument as to whether the provisions of OBA are good or bad from the perspective of our economy and society as a whole. I don't talk about whether provisions of the tax law are good or bad. Nothing is inherently good or bad. It's only good or bad for your facts and circumstances. On this channel, what we're talking about is how to best position yourself within the boundaries of whatever the tax law happens to be. Whether you like the law or not doesn't really matter. Your goal, if you want to position yourself and your family for the most prosperous financial future, is to take advantage of what is being offered now under OBA so that you don't get hammered with extra taxes and unknown and unpredictable law changes that may be coming once you reach your RMD years. So with that in mind, what can you do right now to take advantage of the opportunities under OBA and help secure your family's financial future by keeping as much money as you can out of the hands of the government and in your family's pocketbook? And the answer is evaluating whether doing Roth IRA conversions over the next 4 to 5 years will permanently reduce your family's lifetime effective tax rate. Now, why the next 4 to 5 years? What is the relevance of that time period? And the answer strikes at the heart of one of the most fundamental considerations in tax planning or any kind of financial planning, which is known circumstances versus unknown circumstances. Now that OBA has been signed into law, we know with reasonable certainty exactly what the tax environment will look like over the next 4 to 5 years. We know that many provisions of OBA, including number 1, the senior deduction, number 2, the $40,000 SALT cap limitation, number 3, no tax on tips, number 4, no tax on overtime. All of these will expire in the next 4 to 5 years. None of these particular provisions were made permanent in the law. We also can be reasonably certain that there will be no additional major tax legislation occurring during the next 4 years through the remainder of Trump's current term. By the way, obviously I can't guarantee that there will be no additional tax legislation, but in my opinion it is unlikely, since all of the provisions noted above will expire right around the next presidential campaign cycle. Thus, all of these issues have been teed up to become campaign issues, and so changing them prior to that probably wouldn't make sense from a political perspective. We also know that your RMD years are coming if they are not here already. Every single dollar inside those 401ks and traditional IRAs will be taxed within your lifetime, your surviving spouse's lifetime, or within 10 years of surviving spouse's passing. The more you let that money accumulate in tax-deferred accounts, the larger those RMDs are going to be, and thus the higher up into the marginal tax brackets your income has the potential to get bumped. So that's what we do know. What we don't know is what the tax law is going to be in your RMD years. In particular, if that time period is more than 5 or 10 years away. The more you're concentrated in tax-deferred vehicles, i.e. 401ks and traditional IRAs, the more your money is still at risk to a money-hungry future Congress. What you are doing is allowing allowing your money to sit there and it will face unknown future circumstances regarding the tax law. On the other hand, if you perform strategic IRA conversions over the next 4 to 5 years, and you are able to fill up all of your lower tax brackets that are currently available, thus getting some portion of that money out of RMD territory, then to the extent that you do that and the more you become concentrated in after-tax vehicles, i.e. Roth IRAs, the safer your money will be in the future from the government's prying hands. Once you get that money into Roth designated accounts, it is tax-free forever, including the earnings. And therefore, you have taken some portion of your future retirement money out of an unknown situation, and you have put it into a known situation, which not only creates peace of mind, but reduces your exposure to unknown future tax law changes. By doing strategically planned Roth IRA conversions over the next 4 to 5 years and filling up your lower tax brackets, in particular if you are in the Roth IRA conversion sweet spot, you have the potential to move tens, even hundreds of thousands of dollars or more out of RMD territory, out of a pre-tax vehicle that could be subject to the future whims of Congress, and into an after-tax vehicle where the money will never be taxed again. By the way, if you're new to my channel and you're wondering, yeah, but don't you end up with more money if you let the money grow on a tax-deferred basis inside of the traditional IRA now versus converting it over to Roth now, where it would grow on an after-tax basis? If you just asked that question, then I highly recommend you find 90 minutes and go watch video number 9 in my Roth IRA conversion video series on YouTube. This is what the thumbnail looks like right here. In this video, you will find a complete explanation to one of the most common misunderstandings in the world of tax planning. If you really want to get your family ahead on an after-tax basis, then the examples in this video were made for you. So for everybody in my personal tax planning template program who is currently working on calculating their Roth conversions for 2025, let's take a fresh look at the Roth IRA conversion timeline. I have added a few items down here specific to OBA. So first off, as I have mentioned earlier in the video, there is now a 4-year window from 2025 through 2028 where qualifying seniors can receive up to $6,000 per person in the form of what they are calling an additional senior standard deduction. Based on my preliminary understanding of the law, this will not actually be part of the regular standard deduction. It will be in addition to it, and it will be available whether you itemize or take the standard deduction. So my expectation is that this will be an above the line deduction. And as we saw in the example at the beginning of this video, this is $6,000 per person. So depending on income level, you can get up to a $12,000 deduction here. If you are planning to do Roth IRA conversions anyway in 2025, then I would be looking at this as potentially somewhere up to a $12,000 additional deduction that can offset your conversion income. The prime candidates to utilize this for purposes of offsetting Roth conversion income will be those of you between the age of 65 and 73 years old. This deduction will still be available to anybody over 65, so even if you are over 73, you will still be entitled to it provided you don't get phased out by the income limitation. But as we have discussed many times before, once you get into RMD territory, then often the benefit of doing Roth conversions is minimized. And so the ideal candidates, as I said, are going to be right here in this portion of the Roth conversion sweet spot. Now the second OBA provision, which could be available to anybody within the Roth conversion sweet spot between 59 and a half up to 73, we have a 5-year window from 2025 to 2029. I'm not sure why this one was made 5 years and this one was made 4 years, but whatever the rationale was to put this in here for 5 5 years, you have the ability now to potentially itemize if you have state and local taxes, including property taxes, and if those amounts are in excess of $10,000 and the $10,000 cap under the prior law was causing you not to be able to itemize, now would be a great opportunity for you to start itemizing again if you have sufficient expenses. And the way that I would look at it from a Roth conversion perspective is if you are doing Roth conversions anyway, then this 5-year window of extra deduction that you can have for state and local taxes is just an additional offset against your Roth conversion income that can potentially allow you to convert just that much more income from a traditional IRA to a Roth. And I would take advantage of that now because there's no guarantee that this will remain after the 5-year window is up. In fact, I should clarify on that. When the 5-year window is up, this will automatically revert back to $10,000. Now, of course, as I have alluded to previously, they can always change the law again. Nothing is set in stone, but there would be a requirement that Congress act to make an extension or modification to this. Otherwise, it would revert back to $10,000. Now, taking a fresh look at the Roth conversion strategy tab. If you are in your early retirement during what I'm going to call the OBA years, in other words, you are right here with lower income because your W-2 wages have stopped, but perhaps your Social Security, pensions, annuities have not started yet. You are within the most advantageous part of the Roth IRA conversion sweet spot, and I would be taking advantage of these provisions, which are limited just to the next 4 or 5 years, to make sure and get all of your lower brackets filled up as much as possible to get as much Roth conversion done as you reasonably can without bumping yourself up too high in the brackets. And if you are over here still working, still employed during the OBA years, you should be considering backdoor Roth conversions if your income is too high for a direct Roth IRA contribution. If your income is not over the threshold, you can do contributions directly to a Roth IRA. If the no tax on overtime is applicable to you, that is another great way to generate income that you can use for either Roth contributions or to pay the tax on Roth IRA conversions. And the same would apply down here to no tax on tips if you happen to be a tipped employee, if that's applicable to you. And then, of course, the $40,000 SALT cap, allowing more people to itemize, is available to everyone regardless of age. So right now, as of today, with the passage of OBA, we have right in front of us 4 to 5 years where the tax environment and the tax law is going to be known. So this is a solid 4 to 5 years of opportunity for you to convert as much as you can within the context of your facts and circumstances before we get out here where the tax environment is unknown at this point, and where every dollar that you leave inside of a tax deferred account will be at risk to whatever the whims of Congress might be at that time. There is no better time than the present to lay out your numbers in the personal tax planning template and see where your permanent tax savings opportunities lie. If you wait and if you delay and if you push it off all the way to out here in RMD territory, all of these years and all of these lower brackets that you may have missed are going to be gone. You have to take advantage of the opportunities that are now available under OBA over the next 4 to 5 years, because what's going to happen out here is unknown. But at some point, like we said, Congress is going to need money. And the further away this time right here is for you, the more likely that your retirement money is going to get hammered by small tweaks and small changes and seemingly innocuous things that are almost impossible to notice. And yet they can quietly pull tens of thousands of dollars out of your retirement money over time. By the way, for members members of the Personal Tax Planning Template Program. Keep an eye out this coming week for all new videos and template updates in the members area that are specific to OBA provisions. And if you're not already a member, you can join the Personal Tax Planning Template Program at the link below this video on YouTube. We will be laying out full-blown multi-year tax plans to get every member ready for optimized Roth IRA conversions over the next 4 years, to get your projected RMDs determined appropriately, and to get your quarterly estimated tax payments calculated correctly so you can avoid getting dinged with unnecessary interest and penalties. The Personal Tax Planning Template members area is filled with video tutorials on numerous tax planning topics, and each one goes deep into the details, as many of you have come to expect from number crunch nerds, so that you can gain a complete understanding of the tax issues at hand and make the most informed tax planning decision possible. As always, everyone gets lifetime access for a one-time entry fee to the program. The remainder of 2025 is going to be a critical time for tax planning. Decisions that could impact decades of your family's financial future need to be made in the next 6 months. So with that said, I hope you enjoyed today's presentation. That is going to be it for today's video. Thanks everybody for watching, and I will see you next time.